My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today we've got a special guest. Steeve Breton is zooming in from just outside of Boston, Massachusetts. And Steve comes from the world of high finance and corporate finance. But these days, and for the last number of years, he's been very, very involved in multifamily real estate with Velocity Capital Partners. Steve is also a fellow Canadian originally from Quebec. And it's my pleasure, Steve. Welcome to the show. Great to have you here, my friend.
Pleasure to be here. Thanks for having me.
All right. So, Steve, as we're recording this, my goodness, it's already halfway through November 2025. Maybe give us a little snapshot of what Velocity Capital Partners is all about, what the portfolio currently consists of. Just give us kind of a snapshot, please.
Sure. Yeah, we are a multifamily owner-operator, and we also do syndications. We have a lot of friends and families originally who started to invest with us.
Yeah.
Today we have over 250 investors that are active. We've held or purchased 25 different assets under the Velocity Capital umbrella, and those are all multifamily. Some of it's mixed use, but anywhere from 50 units to 350 units.
Oh.
So, and that's anywhere again from Florida to Texas to Indianapolis.
Okay, so kind of a broad range of markets, kind of broad range of sizes of properties. Is there anything kind of that's like that's perfect for you guys, the perfect buy box for you guys? Are you like value add guys, or do you like to buy them ready to go? Tell us.
Yeah, that's certainly changed over time. We used to be value add, right? We wanted that ugly duckling that we could put a lot of sweat and tears into and really derive the value from it. That got old after a while, and those deals are the ones that are really difficult to run in today's market.
Yeah.
So yeah, we've been moving more towards some of the A-class properties or buying directly from developers. We've also developed a few on our own, and we've had exits across the whole gamut as well from those value adds where we made a ton of money. It was also 2017, 2018. Those exits were amazing because the market was ripping. So we can't take all the credit for the performance on those, but and we've got a new construction deal under build right now, and we're looking at another one not too far from where we live here in Boston.
New construction, as in you guys are developing that property, or you're buying it already ready?
Yeah. So the one we have right now is we also do mortgage brokering.
Oh,
so my son was a mortgage broker for a couple of years after college, and then he came and joined me in the business for the last couple of years as well. So a lot of our deal flow actually comes from people looking for a mortgage. And then as we're working with them, in this one in particular, with this new construction, the developer ran out of his own money, was having a hard time getting a loan. And then as we underwrote it, we're like, you're going to need $2 million of fresh equity. Mm-hmm. And lucky for you, that's what we do, right? We are equity players.
Wow. Well, that's kind of an interesting combination. I think I've done like 2,000 of these interviews, Steve. I think you guys are the first ones that are kind of gone at it from that angle,
Yeah, well, coming from that finance background as well. And my son went to school for real estate finance. So,
okay.
So we brokered the loan. We brought the fresh equity. We also bought the property. We just said, the better structure here is for us to literally just buy the property from you. You can continue to do the build with a a guaranteed max price.
Right.
And then we'll just finish it up that way. So,
well, that's kind of sweet. So you got like a good developer who's financed through you guys. So he's extra motivated to
that's right.
Quality product at the end. And you guys have got this already built out property that you didn't have to worry about laying it, doing the groundwork for it. You kind of got it 3/4 of the way through.
Yeah. And it's a win-win for everybody.
Yeah. Well, that's very, very cool. So, Steve, it sounds like you had a very successful career prior to multifamily real estate investing. You're one of those smart MBA guys in finance and all that kind of stuff, working with big companies. What was it that kind of sparked you about multifamily? Because that's a very different business.
Absolutely.
What sparked you about that? And then what made you decide to kind of just go all in on this?
So, like you said, I was in finance in both biotech and the banking industry, and mainly in the IT space, but managing the finances of IT.
Okay.
And there was some corporate restructuring happening, and my position was a little bit, unsettling. Although I've never been laid off, but I was nervous at the time, so I started to invest a little bit on the side.
Okay.
Bought a duplex here in my backyard, or a mile away. Did all that management, and I wasn't afraid to take on, value add duplex, triplex sort of work because my whole family's in construction.
Okay.
I'm the black sheep who went to college.
Well, chances are you swung a hammer or two.
That's right.
In college.
Yes, exactly. Yeah. My dad made sure of that. Yeah. So, a duplex led to another one and to a few triplexes. Next thing I knew, I had 25, 26 units, and things were going really well. My friends wanted to invest with me as well, but they didn't want to do any of the work.
Yeah.
So I started looking at leisure properties, and, a few friends came in. Next thing I know, this all started in 2012.
Okay.
By 2017, I had launched Velocity Capital, and we were then buying, 106 units here and 85 units there. And we did some of that with other partners who lived in those markets. So, one was in Tampa, Florida, one was in San Antonio, Texas. But again, it was with somebody that I knew who lived in that market, who was a multifamily investor. And I did all the capital raising, all the financing part of it, investor relations, all the legal aspects as far as the securities laws, and making sure that we were compliant there.
Yeah. So that's kind of a lovely combination of your corporate skills and real estate all coming together. So at what point did you decide to pull the plug and go all in full time into real estate?
Beginning of 2019.
Okay.
Literally, my work was getting in the way of like me building a sustainable business. And I also had my sons. I have 3 boys. They're all in their 20s. And I had an inkling that they wanted to join me, right? So, and like I said, a couple of years ago, my oldest joined me, and there's another one coming right behind him. They have to do their 2 years in corporate first, hopefully in a space that'll help us out when they join us. But
smart.
But yeah, so now we've got this amazing business that's going to be a family business with multiple generations, and hopefully further generations to come.
That's really smart. Sometimes the whole getting family involved with the business is a little shaky, but it sounds like your boys have got good heads on their shoulders, and I like that idea. Go get them trained up on somebody else's dime.
Exactly. Yeah. Learn some asset management or corporate finance, or whatever it is, operational.
Bring that skill set over once you've got it.
And we've also since hired an asset manager as well. So they're dealing daily with all the property management companies for our portfolio. So now I can step out of that day-to-day manager of each property and start focusing more on the business and all of the procedures and different things that have to happen within the business itself.
Right.
Making sure that our processes in terms of looking at financials every single month. Who's doing that exactly? What are we looking at? What are the guardrails that we're measuring performance by? Making sure that the distributions are going out to our investors every quarter. So
lots of stuff to oversee. That's for sure.
Yeah, it's a real business.
Well, that's what I was going to ask you, Steve, because I've spoken to quite a number of people that have gone from corporate into real estate or into business for themselves of whatever sort, right?
Mm-hmm.
And for a lot of folks, it's a huge adjustment because when you're in corporate, you're in your office and you've got your responsibilities.
That's right.
Somebody else is taking care of sales. Somebody else is taking care of marketing. Somebody else is taking care of customer service and all that kind of stuff. And you're kind of in your lane. Then you start your own company. It's like, boom, chief cook and bottle washer, do everything. What was your experience with that? And how did you kind of adjust those first couple of years to?
Yeah. So my MBA was in entrepreneurship.
Oh, okay.
And that was early on, right?
Yeah.
Early in the career. But I learned about, all of the different aspects of running your own business. We did a lot of case studies, and that was all wonderful, but it still took me 20 years to finally get the nerve to leave and do my own thing. But in those 20 years, it was always in the back of my mind. So I paid a lot of attention to business operations. And a lot of the things that we worked on the finance side, you can tell a lot about how a business is run by the finances. Mm-hmm. And so just digging through the financials and then going to ask questions, why did this happen? Why did we spend so much money here? You can start seeing people start telling you stories. Well, we made this mistake with this other thing. Then we had to make this investment over here to make up for it. And so you hear a lot of stories and start to figure things out. And we also, these were large companies I worked for. So I had multiple layers of people working below me. So I had to learn how to manage at that level, right? As an actual manager, not a doer all the time.
Right. So you learned a lot of leadership skills there and management skills.
Yeah. Yeah. And all the, again, process improvement work and making sure everything's documented. And we were also in highly compliant industries. So all the compliance work and documentation there and the legal, I got used to that
perfectly to, translates perfectly to especially investor relations and syndications and
that's right.
With all that stuff. Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Okay, very, very cool. So, Steve, everybody in multifamily, almost everybody in multifamily in the last few years has taken a bit of a kicking in with what's gone on with interest rates and the property values and rents and, taxes and all that kind of stuff. How has that affected you guys and Velocity?
Yeah, I think the biggest issue has been people that took a variable rate loan in 2021, 2022. Yeah. And then, 2023 interest rates went up by 5%, which is enormous. That's unprecedented. Yeah. So those folks have suffered the most. We had a couple of those loans, actually 3 of them. We refinanced out of 2 of them in early 23, just prior to those rates going up, which I think one of them was just after that first hike, but we were already in the process, right? Because it's a value add property. The variable rate loan made sense at the time because you're going to value add, you're going to refi because it's going to be worth so much more later. Mm-hmm. And then the third one, we had a partner that was very difficult. And that's probably my biggest lesson, which may be your next question. Mm-hmm. Difficult partner, didn't refi it soon enough. Things got a little bit ugly. Then we had to try to step in and just... it's not good for anybody, right? Like they always say, winning cures everything in the locker room, right? So if you have a tough season, the locker room gets a little bit tough. People aren't getting along as well. Yeah, and that applies to real estate just as much. And it's absolutely a team sport. So you have to make sure everybody's happy and aligned. And so now we're a bit more careful. The lesson coming out of that is that we're super careful about who we partner with. Also super careful about how we document our partnership, who's doing what are the roles and responsibilities. It used to be a little bit more easy to just kind of walk into things together and be like, yeah, we'll figure this out, right? Because it was a really easy time in the marketplace. But now, with inflation as well, everything's more expensive. So we have to manage expenses to the penny every single week. We're looking at that across the board on our portfolio. So yeah, we're very careful and cautious about how we're proceeding. We've also launched a preferred equity fund, which puts us in a better position. So our investors are now coming in between the common equity and the bank. So they're sliding in between there. They get some of the benefits of the bank where they're getting their money back before the common equity providers or investors. So there's some protections there. And then they're also getting some of the upside as though you were a common equity. So we're What we
Yeah, I
do
think a
here is
lot of
going to
people are-
eliminate a little bit of the downside, but to do so, you have to give up a little bit of the upside as well.
Okay. Yeah, that makes sense. I've heard a few people kind of doing one variation or the other of that. So where do you see the biggest opportunities coming down the pipeline in the next year, 2, 3 years, Steve? What does your crystal ball tell you?
Yeah, I'll say, everybody's optimistic, and I try not, I certainly don't underwrite to this sort of optimism.
Yeah.
But in my heart, I think that rates are going to go down substantially here over the next year. I think the market, from a real estate perspective, is going to pick up some. And a lot of the overbuilding has ended with all these high interest rates. So those fell off the cliff probably 6 to 12 months ago, depending on which city you're in.
Right.
So there's a lot of things pointing to higher rents, nice exits, people being able to sell that deal that they had to hold on for an extra year or two through this market. We've got a couple ourselves that we've had for 4 years now, coming up on 5 on one of them. And we're probably going to have to hold it for another year because we could sell it now and make a profit, but why not wait another year and make a much nicer profit?
Exactly. Yeah.
So profit taking is going to happen. At the same time, you have to figure out where you're going to reinvest and what are you going to do with your tax situation, because you're going to have that. Hopefully, it's only a 20% capital gains tax, but then you've got your own state tax or provincial taxes or whatever it might be. So we focused on recently some opportunity zone deals. That new construction project, that one's actually opportunity zone. That's my second property in an opportunity zone.
So for folks who aren't familiar with what opportunity zone means, what is that?
So that is legislation from 2017. It was actually under Trump, but it was put together by the prior administration. But it finally passed in 2017. And what that does is it gives tax benefits or special tax benefits to people that are investing in certain areas that were designated as an opportunity zone. And all that means is, it's sort of a blighted area in a downtown city. So across the U.S., each governor was able to select certain tracts of land or neighborhoods, essentially, that were opportunity zone. And when so let's say you sell a property that you've owned for a few years, and you get this big capital gain, or it could also be stocks or Bitcoin or anything that you sell. You have a capital gain. If you reinvest it in an opportunity zone, you're deferring your taxes.
Okay.
And then the property in that opportunity zone that you invest in, you essentially can operate that property for 10 years is the maximum benefit. So if you hold it for 10 years, you get a full step up in cost basis. So you're essentially not paying any taxes on your sale of that property that you bought in the opportunity zone.
Wow.
So by the time you sell it, if you have to recover your taxes from the first sale, because you're not paying taxes in the new one, it all kind of washes out.
Okay.
And the other benefit that this may be a little much for some of the people listening, but when you take depreciation expense, so like this 100% bonus depreciation,
right,
that can offset a lot of your taxes from other things that you might have sold or income that you've earned. In an opportunity zone, you can take 100% bonus depreciation and you do not have to recapture that when you sell the property.
Okay.
That gets washed away with that 100% cost basis. So a little bit technical, but the tax benefits for OZs are amazing. So we focus there. We're probably going to launch an OZ fund. That'll be our second fund in the beginning of 2027, so Q1. Because
dumb question, Steve. I get it. I think I get it. What the government's trying to do there.
Mm-hmm.
What kind of properties are you typically buying or building or investing in these opportunity zones that make sense?
Yeah. So the rule is that you have to put in as much money or capital as it was to purchase the property. So if you buy a really dilapidated 2-family, a duplex or a triplex, you have to literally double the capital expenditure. So you've got to rehab the whole thing. Otherwise, you haven't met that criteria and you can't get the OZ benefits.
Okay.
So that works. Another way that
and then for your perspective with an apartment building, same idea, right?
Same idea. It was an old dilapidated restaurant, but it had a fairly large footprint.
Right.
So, and it's downtown Manchester, New Hampshire. So you're able to build, 9, 10 stories if you want.
Okay.
So this one happens to be an 8-story building on that footprint. So, the cost of construction, $20+ million, but the purchase price was far less than that of the original property.
No problem with that.
Exactly.
So I guess fundamentally, though, if these are kind of quote unquote blighted areas, are you going to have the prettiest building in a war zone, or what's that looking like?
That is always something you have to be concerned with. Yeah. So, unlike you hear a lot about gentrification.
Yeah.
And you hear about people going into these areas and like, okay, the path of progress is in this direction. And one day my property is going to be worth so much more. And they go in there and they do the renovation. It might be 2 or 3 years, like you said, of having kind of a war zone around you. Mm-hmm. With opportunity zones, people move in much more quickly because the tax benefits are so amazing.
Okay.
So there's a lot of pressure to get these properties, to purchase them. A lot of pressure on the current owners to sell them at a much higher profit than they would
less risk of it being a war zone after.
And things move. Yeah, things move very quickly. The one that we just got into, that was certainly one of our considerations. Mm-hmm. There's already been a lot of development in that area, so we're kind of one of the last ones remaining.
You're not the pioneers then,
right? Exactly.
Smart. Very, very good, Steve. This has been fascinating. Time flies when we're having fun. So if people want to find out more about you, find out more about Velocity, where should they go?
Easiest way to get a hold of us is velocitycap.com. That's short for Velocity Capital.
Perfect. Steve, thanks very, very much for being on the show.
It's a pleasure. Thank you.
All right, everybody, take care, and we will see you on the next one.
Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.